Good morning from London. I'm Anna Edwards alongside Kriti Gupta and Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Joe Biden vows to stay on in the presidential race, but two high-profile gaffes at the NATO summit prompt more Democrats to call on him to drop his re-election bid. Reports emerged that US and German security services foiled a Russian plot to kill the boss of one of Europe's largest arms manufacturers. Plus, US inflation cools to its slowest pace since 2021, fueling bets the Fed will cut interest rates more than twice this year.
And a quick check on those markets. I'm going to work my way from the bottom up here because off those Fed bets, you are starting to see a two-year yield at 4.51. Again, slight bit lower, but not that much action this morning. Does that change going into those opening trades? Cable at 129, outperformance right here in the UK with FTSE 100 futures higher by 0.3%, outperforming Euro Stoxx 50 futures flat on the session. The countdown to the opening trade starts right now.
I'm determined on running, but I think it's important that I allay fears by let them see me out there. Let me see them out, for the longest time it was, Biden's not prepared to sit with us unscripted. Biden's not prepared to, anyway. Now I want to hand it over to the president of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin. President Putin. We're going to beat President Putin. President Zelensky. I'm so focused on beating Putin, we got to worry about it. Anyway, Mr. President.
I'm better.
You are a hell of a lot better.
What concerns do you have about Vice President Harris's ability to beat Donald Trump if she were at the top of the ticket?
Look, I wouldn't have picked Vice President Trump to be vice president.
U.S. President Joe Biden at the NATO summit really digging in his heels a little bit, Anna, but also making a couple of stumbles along the way.
Yeah, absolutely. If we start with the performance itself, away from those gaffes and the messaging he was trying to get across, he is saying that he's staying, he's not backing down. And according to our reporters who were in the room and witnessing all of what was being done and said at the NATO summit, he was talking confidently on a whole range of subjects throughout this hour. So, there's more to the hour than the two gaffes. So he was talking about the tax code, about trade policy, about Israel, Hamas, all tough topics and all across the detail of all of those. But of course, when you confuse Zelensky and Putin, when you confuse Harris and Trump, that is where the media is going to focus, and that is where his own party is focusing. 3 House Democrats then calling for him to go on the back of that, even though to some degree there was something in it for both sides to say, look how he performed.
Yeah, it was toe curling, frankly, wasn't it, listening to those sound bites? But as you're right to point out the context, but she fielded a lot of context, a lot of detail in terms of these other topics as well. And let's not forget that Donald Trump himself suggested injecting, what did he say, injecting some kind of bleach or something during COVID, when people were literally dying during the pandemic. So you talk about gaffes, verbal missteps. It's not a great look. But, that is not quite on the par with Trump back during the height of COVID. Yeah. Another really intriguing story. Look, this ties into the conversation, of course, in Washington around how to contend and confront Russia, because we have the story that US intelligence agencies have picked up on this plot to assassinate the CEO of a major weapons maker in Germany, Rheinmetall, and the CEO's name is Armin Paperger, and apparently they passed this information on to the Germans who blocked it. But, Kriti, you've been looking into this. This is a reminder of the hybrid warfare that Russia is waging on Europe.
Yeah, you're seeing this on multiple fronts, especially when we're talking about, yes, the physical kind of weapons, supply chains, et cetera, and that end up. You're seeing this in the business front. You're seeing this in cyber attacks, for example. In the last 2 or 3 years, you look at it from a market perspective, not only have defense stocks outperformed, but cybersecurity stocks, because Russia really has an expertise in that kind of warfare. But on top of that, you've got some new alliances being formed. Viktor Orban just made a trip over to Moscow, to Beijing, then to Washington for the NATO summit, and I believe tonight is meeting with President Trump at Mar-a-Lago.
Yeah, so it really has been a multifaceted NATO summit, hasn't it? There's been the official announcements around support for Ukraine. There's been the subtext around European leaders trying to get time with Trump's team because they're not sure which way the election's going to go, and so Biden's performance plays into all of that. And then on top of that, you have seemingly now a new threat to some CEOs in Europe who are making weapons for Ukraine's war effort. We, though, must get back to some of the other stories that we mentioned in our headline around the markets. And CPI yesterday had a really interesting lasting impact, certainly on stocks.
It does. I mean, you have that geopolitical overhang, and then you have a 12 basis point move in the Treasury market off of a CPI report, which probably for the first time, I think since 2020, you actually saw a negative reading in the inflation print. That is a really big deal. But I think what I have to caution here is that even though we see some of the core coming down pretty substantially, look at the parts that are rising. We're talking still about rising housing costs, rental costs, et cetera, driving a lot of the moves upward as well. So I think it brings up to the point of what does a Fed pricing look like when the mechanism towards that housing is still kind of delayed.
Yeah, and to Anna's point around the intriguing market reaction, that rotation was pronounced, wasn't it? So the sell-off in big tech and the moves into the Russell 2000 with gains of 3.6%, 3.6% versus the downside. So a difference of almost 5% between the Russell 2000 and the Nasdaq.
It's interesting
100.
to explore the market's mentality and mindset at the moment then. If that softer inflation print leads to selling of big tech, you know, we can ask some of our guests today about what that tells us. Interesting, while we're talking about market dynamics, was there or was there not yen intervention yesterday? Seems to be another one. We don't get official confirmation at the time that any of this ever happened, so we'll have to wait and see whether it is confirmed or not. But a lot of people saying if it were, it was good timing because it was pushing on a weaker dollar. It was a time when the dollar was weaker and we saw substantial move higher in the Japanese currency. Let's tell you what else is coming up on the programme then. Lots to discuss with our guests. We'll discuss that slowing CPI data out of the United States with Ralph Prosser from Bank of America Global Research. Plus, we talk everything equities with Citi's Beata Manthi and all things corporate credit with Omotunde Lawal from Barings. And we'll wrap up the week with a look ahead to what's next with Wellington Management's Supriya Menon. Let's return, though, to the NATO summit, where US President Joe Biden has vowed he will remain in the 2024 presidential race, despite two critical mistakes in the span of 2 hours, deepening concerns about his abilities. Let us get to Ben Sills, who has been covering the developments at the NATO summit for us. Ben, we talked about some of the news flow that's come out of it. It's sort of been multi-pronged, if you like. But I guess the story that overhangs all of this is the abilities and the capability of President Biden right now, seemingly talking very confidently on a host of really technical subjects, but then, you know, getting some names confused, which, of course, people are jumping on.
Yeah, that's right, Anna. Coming into this, all the attention was on Biden's performance. I remember last year they were trying to nail down this very kind of specific deal over Ukraine. There was no specific concrete deliverables they were looking for this time. So the issue was, how's Biden going to do? And you know, you've said rightly that he did speak fluently for large periods of that, but at the end of the day, those mistakes are so kind of shocking that that's going to overshadow everything.
But Ben, when we talk about how the international community views this, is there still that confidence in his leadership when it comes to things like Trump-proofing NATO, for example, or is that also under quite a bit of more scrutiny, especially given the likes of Viktor Orban heading to Mar-a-Lago to speak to President Trump tonight?
That's a really interesting question, actually, because we were speaking to some of the delegations last night, and I think that there is confidence in Biden in the sense that he has the respect of European leaders. They recognize his achievements. They, I think, in many cases enjoy working with him, but they also feel that the deterioration in his faculties is now too serious to ignore, and they don't really they feel a degree of sadness, I would say, about the way this is unraveling. But you know, one European official was saying just last night that this really has to be the end. They couldn't see how he can continue like this, because of course you're not looking just at the November elections, but if he were to win that, another 4 years, and that's very difficult to imagine.
Ben, given where you sit, and of course you have a finger on the pulse in terms of what we're hearing across Europe, what is your sense of where international allies of the US are kind of landing on this question of Biden? We heard from Keir Starmer. I mean, obviously, he has to be diplomatic, talking, I think, to the BBC and saying, you know, look, he found Biden to be incredibly competent across all the detail, and no concerns there. What are you hearing on and off record from leaders across Europe in terms of this question?
I think that it's true that he remains competent and sharp in these private conversations, but there's also a sense that his propensity to make these mistakes in public is not viable. And the people are kind of holding their breath to see how this is going to unfold. It has to resolve itself in the next month or so. The Democratic Convention is coming up in Chicago, and so I think that the European leaders are just kind of waiting to see where we'll be come the end of the summer.
Okay, holding their breath as we count down to that event. Ben Sills with the details on the latest. Thank you very much indeed. Here's what else you need to be thinking about this morning. Bloomberg has learned that Turkey is scaling back a planned $23 billion contract with the US to modernise its fleet of F-16 fighter jets, the second largest in NATO. Ankara is now pushing to buy fewer upgrade kits and munitions to save billions of dollars amid spending cuts at home. Retail investors withdrew £1.8 billion from UK equity funds in May, the worst month on record for the unloved sector. The figures from the Investment Association add to a dismal trend for British funds, which have seen 8 years of continuous retail outflows, totalling £54 billion. And Tesla shares fell after it postponed the unveiling of its robo-taxi until October. Bloomberg understands the car maker wants teams working on the project to have more time to build additional prototypes. Optimism over the launch, originally scheduled for August, had contributed to an 11-day streak of gains for the stock that added more than $257 billion to Tesla's market cap.
We've also got a couple of other things to watch on the agenda. Of course, we did just come off that CPI report as well. Well, today it is now time to look at the PPI numbers as well, plus the UMich consumer sentiment. Both of those, I believe, PPI numbers coming up at 8:30 a.m. New York time, so it'll be 1:30 p.m. UK time. And then, of course, the UMich sentiment coming at about 10 a.m. New York time, which is 3 p.m. UK time as well. Plus, of course, those Wall Street bank earnings starting to kick off. What do the likes of JP Morgan, Citi, Wells Fargo, BNY Mellon, of course, have to say, not just about Treasury liquidity, but also about those potential Fed cuts that the market is now pulling forward?
Absolutely. So when we look at bank earnings, interest rate sensitivity, the way that those businesses respond to the rates environment and rate expectations will be in focus. Also a focus on, loan loss reserves and credit quality, but investment banking and a rebound there. And you were just yesterday at that Bank of America conference, Tom, and talking to international voices from Bank of America who were saying, yes, we have seen a bit of a rebound in capital markets activity. OK, from a pretty low base.
Yes. Yeah, Bernie Menser, international president of Bank of America, as you say, saying, yes, the capital markets, he thinks, are kind of turning around a little bit, and that demand is picking up, both for trading and for the investment banking. So we'll see how that plays into, if it's all into these results. But really interesting, because the focus has so long been on net interest margins, hasn't it? And now it seems to be on whether or not that deal activity is really picking up and kind of can offset maybe a little bit of pressure when it comes to NIMs. Yeah,
I think the comments of JP Morgan in particular are going to be really crucial. I think everyone has their eye, of course, on what Jamie Dimon is going to say around that logic. I'm going to put my focus on BNY Mellon, though, specifically because we've just had, I think Politico did some great reporting on this, the CEO of BNY Mellon talking about the kind of adjustment around Treasury flows. You and I have talked a lot about this on the show and about how much foreign demand you're seeing for U.S. Treasuries versus that. Well, BNY Mellon works very closely with the New York Fed in terms of all of that market plumbing. So it'll be interesting to see what BNY Mellon specifically says on all of this bond stuff.
OK, market plumbing in focus as we get towards the bank earnings story. With that in mind, coming up on the programme, we'll dive deeper into this story. Wall Street lenders set to kick off earnings season with Citi, JP Morgan and Wells Fargo reporting quarterly numbers just today. We'll get more next week, of course. We'll tell you what to expect. Plus, we'll bring you your stocks to watch, including the Swedish telecom equipment maker Ericsson, which has reported an earnings beat this morning. Up next, we will be joined by Ralph Prosser from Bank of America Global Research to discuss the cooling US inflation data, the Fed's next steps. We'll also get thoughts on the yen and what's driving the currency exactly. If you have questions for our guests, please get in touch. IB plus BBTV Go is the function to use this morning. It's Friday. This is Bloomberg.
The economy looks as if it's slowing. The labor market looks as if it's coming back to normal. Inflation looks as if it's coming down.
This is one of those times where, okay, the Fed is going to cut rates. We've been clamoring for cuts. Is it actually a good thing, though? And I think that's what markets are really dealing with.
I think they should go in September.
I do think they will start to cut in September.
They just need to be steady as they do this.
I still think that they'll start with 25 so as not to scare anybody.
If they rush it, it's going to actually look like they're scared about something.
If they move too quickly, the expectational set in the market could get ahead of themselves.
I still think September, December, March, June, September, December. 6 rate cuts, 1.5 years. I think that's what they should do.
Go slow, take your time. You've got a winning hand. Why would you do anything today or potentially September to destroy that winning hand?
Bloomberg TV guests reacting to June's U.S. CPI report, of course, coming yesterday and seeing a pretty interesting market reaction off the back of it. Investors still seeing higher inflation and a hard landing as the most underpriced risks to financial markets. This all, of course, comes ahead of the U.S. election and the broader deficit story, the fiscal outlook as well. That's according to a survey from Bank of America Global Research published today. Joining us now, Ralph Presser, Global Head of G10 Rates and FX at Bank of America Global Research, joins us around the table this morning. Pleasure to have you. I want to go into the market story in a second, but first, it feels like off of the CPI report, the idea that the market's now pulling up the prospect of a cut now to September, I believe, which was largely taken off the table given the proximity to the election. What does that mean in terms of the lag between when the Fed cuts and when it shows up in the real economy?
That's an interesting question because this isn't a normal cutting cycle, right? We're not cutting in response to obvious signs of recession risks. We are cutting because we are leaving a big supply shock behind us, and as a result, inflation is coming down, even though growth is still very decent by all measures.
Yeah.
So from that perspective, are we really wanting to see the U.S. economy reaccelerate from here? Probably not, right? But what we're trying to avoid is those nascent signs of the economy moderating actually turning in full-blown recession risks, and that we won't know until mid-2025 whether or not that was successful.
But there's an argument out there that in terms of the traditional 12 to 18-month delay or lag that is supposed to be Econ 101 of the Federal Reserve doesn't apply this time around because of this cutting cycle or this hiking cycle, because there's so many funds and so much money on the front end of the curve parked. So the mechanism more comes from the markets than from the Federal Reserve itself. Do you buy that argument?
I think there's good reason to expect the transmission to be slower, just like it was slow on the way up, right? Remember that lock-in effect that we had in the mortgage sector that meant that the normal cash flow impact, well, not normal, but the cash flow impact that we saw, let's say, in 2004, 5, 6 in response to the rate hikes into the mortgage market didn't happen this time around because people locked their mortgages in. The same is going to be true in reverse, right? It's going to take a long time for mortgage rates to fall sufficiently for people actually to be able to refi and get a better mortgage deal than the one that they have right now. So again, that transmission mechanism is likely to be slower into certain parts of the economy. But obviously, when it comes to undertaking the marginal investment decision, the marginal decision to buy houses, those will react quite quickly. And that is probably all that you actually want to see react, because, as I said before, it's not clear to me that you want the economy to reaccelerate from here. You just want to avoid anything other than a soft landing.
So, Ralph, what number of cuts are you pricing in at this point, and where does that leave you in terms of where you want to sit along the curve? We're at 4.50 on the 2-year right now. Do we get below 4% by the end of the year?
By the end of the year, I think it's going to be slightly tricky, but if we assume, so our economists are still looking for one cut in December. We're going to wait for the PPI numbers to see how those...
You don't see September, they seem December.
We currently don't see September. The risks are obviously there, but our base case currently still is that the Fed is going to be cautious and is not going to move until December. But as I said, we get a lot of important data between now and September, so that could change. So getting 2-year all the way down to 4%, I think, is going to be a little tricky. I think it will take longer than people think for the curve to actually meaningfully disinvert still. But at least finally some of those long-held consensus trades are starting to work, like the steepener, like the overweight duration stance that we also saw clearly in the survey that you mentioned.
Where does US politics take us at this point, Ralph? Because it, you know,
favorite question.
Right. Well, sometimes we zoom in on this and we look for evidence that the US election race is having an impact on bond markets and steepeners, for example. And other times people say, no, it's not to do with that. It's other things entirely. Where do you see evidence that people are playing the election?
We see very little evidence, meaning when we poll investors, as we did this week, about how you're positioning yourself going into the election, The one trade that people have some conviction in is the steepener, but by and large the response is, I'm not trading the election. And the reason is simply that the election is in November, and we're debating at the moment whether or not the Fed is going to go in September. So there's a lot that can go wrong from a rates markets investors' perspective even before we get to the election. So I think we'll have a much bigger focus on how to trade US politics once we actually get past Labor Day, once we get past the September FOMC meeting, and we're that little bit closer to the actual event.
Yes. So we see politics having a role or not, as the case may be, in US rates markets. In FX markets, there's politics and other sort of government actors at work, perhaps in Japan. Perhaps. And it's all, chatter about intervention, and we never get the confirmation at the time, do we? We have to wait and we see. Does it look like intervention? I mean, some people were, as I said at the top of the programme, were suggesting if you were going to intervene, yesterday was a good time to do it. The dollar was looking soft on the back of that weaker CPI.
It does. I mean, given the size of the move, given the timing of the move, I'd be surprised if there wasn't a big flow behind it. Could it have been a private sector flow? Maybe. But, I mean, let's be honest, there is a good chance that it was the BOJ that actually used the opportunity of the CPI print to try and get more bang for its buck in terms of intervention than it would otherwise have gotten. So that's probably what we will conclude once we get the official data in a few weeks' time. But ultimately, the challenge for the BOJ really is that all that they can do is try and prevent that buildup of speculative interest in the yen short, which yesterday certainly would have taken care of. But the underlying pressure on the yen is still there, right? We do face this underlying story of capital outflows that is going to make it difficult for the yen to really reverse course until we get confirmation of the cutting cycle actually starting in the US.
Well, can we continue our tour around the world and talk about the European currencies as well? You're looking at euro dollar at 108, cable at 129. I've seen calls for 130, 132 on cable as well. How much of that is a function, though, of dollar weakness that's temporary, especially ahead of the U.S. election, as opposed to fundamental strength in Europe?
It is more a question of dollar weakness, but it's dollar weakness from historical strength, right? Meaning the dollar is overvalued on any measure, right? If you look at the real effective exchange rate, it is at an all-time high. It does make sense for the dollar to start giving some of that up. What has been preventing that from happening until now is the fact that we had this uncertainty about when the Fed would actually start going. Remember, until quite recently, we were debating whether or not other central banks would be able to cut if the Fed doesn't. That uncertainty now is meaningfully reduced. That will certainly help the dollar give up some of that richness. But there are also stories that underpin other currencies, maybe not so much the euro, but if you think about sterling, sterling has suffered from this political uncertainty. It has suffered from investors wanting to... Sorry.
No, so on that, just before we let you go, because we're running short of time, your next level for the pound, and do you buy gilts?
We don't buy gilts. We are still short real yields. We don't see any value in the UK as such. And next level on sterling are probably some of the numbers that you mentioned, 130, 132.
OK, I'll book my holiday. Ralph, thanks very much. Woo, big moves, going to make all the difference. Ralph Russell, thank you very much. Global Head of G10 Rates and FX at B of A Global Research. Lots to discuss when it comes to US rates markets, the yen, the UK assets, much beyond. Coming up on the programme, more on the markets. We will speak to the head of EMEA corporate credit and emerging market corporate debt at Barings. We got a very positive take on credit markets yesterday. Some voices surprised, others just reassured that spreads have stayed as tight as they have in Europe despite political turmoil in France. We will get to that conversation shortly. This is Bloomberg. Welcome back to the programme. It's Friday morning, 30 minutes until the start of Friday's opening trade here in Europe. So let's have a quick look at where we are on these markets. And the futures picture looks like this. A bit of positivity, actually, for European stocks. That's despite some of the negativity of yesterday's session over in the United States. So during yesterday's session, we saw, the Nasdaq down by nearly 2%, the S&P 500 down by 0.9%. Despite all of that, looks as if we find some reasons to be a little more cheerful here in Europe. European futures then seen higher. US futures look pretty flat this hour. Quick check on the bond markets. Of course, the big watch has been around the French bond markets and the French spread over Germany. We don't see a huge amount of movement in these bond markets this morning. We had an extensive conversation about where we are on government bond markets just a moment ago with Ralph Prosser from Bank of America. So all interesting stuff there. Not trading the politics is the message he gets from clients when they've done these surveys of clients. Let's turn our attention to the corporate debt markets, though, and particularly around France. We spoke just yesterday, in fact, to Stanislas de Beyancourt, who's from Sycamore Asset Management, where he's head of fixed income and asset allocation. And we were asking about corporate credit and whether he was surprised that despite all the tension over in Paris politically, whether he was surprised that spreads were as narrow as they are. Let's have a listen to what he told us.
Even though going into the elections, so post the shock of the announcement, the markets were dynamic. Demand was strong, both from local investors for France, but also European and international investors. On the fixed income side, and even on the corporate debt side, there was strong demand from that, and it's really business as usual. Things are going pretty well. Corporate spreads are nearly back to the narrowest level for corporate credit in France and globally in Europe.
Joining us now with another perspective on corporate credit markets, Omotunde Lawal, head of EMEA Corporate Credit and Emerging Market Corporate Debt at Barings. Tunde, nice to speak to you. Thank you for coming in.
Thank you for having me.
So we got that perspective yesterday that it's business as usual in French corporate debt markets. I mean, either thinking about France or Europe broadly, should that surprise us, given the political story we've seen unfolding in France?
Yeah, it's slightly surprising because we've seen that the aftermath of the parliamentary elections in France is a lot more uncertainty from a policy perspective. And so we have seen French corporate spreads widen. We temporarily saw some contagion to Italian spreads as well. But the Italian stuff has since then sort of come back, and some of the French stuff has since then snapped back. But we still expect over the next few months that there's going to be a knock-on impact on business sentiment, consumer sentiment, which will have an impact on spreads staying at slightly elevated levels for a while. So I think there'll be some retracement, but I think we'll probably still be at that elevated level for a while.
So should we at all be surprised that we've seen rates go up as quickly as they have globally and corporates have coped as well as they have, and we haven't seen more defaults? I mean, maybe we shouldn't be surprised given that, Treasury departments and teams at these big businesses are used to now borrowing for the long term when rates are low and then not having to refinance very soon. I mean, how do you evaluate how corporates have coped with this big ramp up that we've seen in rates?
It's actually been quite interesting, I'd say, because I wear two hats, an emerging market one and a DM one. I'd say from the emerging market perspective, it hasn't been as surprising for, I guess, the insiders to see how the corporates have been more resilient, because typically EM corporate treasurers and CFOs tend to be quite sort of well attuned to being able to navigate more sort of treacherous terrain in their markets. They know that the capital markets can be shut to them at any point in time. And so they tend to run relatively conservative balance sheets. You look at the balance sheets of EM corporates, your average leverage there is only about 2 times, 2.1, 2.2. And you compare that to an equivalent US high yield, that's about 3.5, almost 4 times. And so your average corporate treasurer in EM is already quite sensitive to the fact that they can't have too much debt and they can't sort of be too complacent about when the window's open and when they need to access the market. And so they've actually been quite good at front loading and coming to the market when they need to come to the market. This year, for example, we've had year-to-date supply about 230 billion from EM corporate issuers, which is on track to be one of the better years since the last sort of 2 to 3 years, right? And that's because they know that they needed to come to the market. They've de-risked themselves. Some of them have 2, 3 transactions to do. They get them done first half of the year because they know second half is going to be a little bit more treacherous. Whereas on the sort of DM side, I've seen where I think in Europe also, we're seeing a bit more sort of supply coming through in the first half as well. You see that Europe, the ECB is already on the sort of cutting path already ahead of the Fed. So you're seeing the European corporates are actually also coming to the market. So not too surprising, actually, that corporates are being a lot more resilient because EM corporate balance sheets tend to be more resilient. And Europe, the recession didn't really materialize, and so those corporate treasurers are also coming through the market and getting stuff done ahead of U.S. elections.
How much of that, though, is a function or even a reaction to the record amounts of cash on corporate balance sheets post-COVID and post that fiscal spend on both sides of the Atlantic? It feels like this re-leveraging narrative is more a reaction to the last couple of years rather than some sort of positive kind of trend. How would you view that?
Well, actually, a very good point that you make. I think we all came into COVID not quite knowing where the world was going to. And so to be on the defensive side, a lot of treasurers did build a lot of cash, higher cash balances than they ordinarily would because everyone was sort of nervous about what the future held. But I think and then obviously a lot of CapEx plans and all these sort of plans were put on hold. Since then, we've seen corporate treasurers and business activities starting to normalize. We've worked our way through Russia, Ukraine, and the energy crisis and all of that. So CapEx programs are starting to come back. Now we're hearing from the banks that we're speaking to that actually it's not just about working capital lending now, it's about CapEx lending. So cash balances are starting to come down. And that's why you're seeing a return of activity to the primary market as well, because people are coming to fund not just refinancing needs, but also growth and expansion as well.
Tunde, we may be then on the brink of a rate-cutting cycle finally from the Fed, possibly in September. Markets are pricing that first cut in September. Traditionally, of course, you get to a rate-cutting cycle from the Fed, benefiting EM. Where do you position within EM on the likelihood of a cutting cycle from the Fed? What benefits within that space?
Okay, so from our perspective, we think as the Fed starts to cut, we're expecting that actually that should be quite positive for overall emerging markets on the sort of a dollar receding, dollar strength receding. So for us, from that perspective, we do like sort of businesses that are a bit more tuned to global growth and sort of exports from that perspective. We like sort of businesses that are more tuned to the energy transition. So we're doing a lot with renewable power projects, infrastructure projects. A big part of that is happening in the GCC and the Middle East. So, we like things like that where it's all about sort of commodity, sort of shifting yourself away from the sort of heavy reliance on hydrocarbons, infrastructure growth, all the things that sort of speak to more resilient sort of business models, things like that. We also do like things around nearshoring in Mexico where it's really about, okay, Fed is cutting rates in the U.S., there's the IRA, CHIPS Act, all these things that are going on in the U.S. that maybe emerging market countries can also benefit from and tag along to that. So
I wonder if Mexico is also part of the story when you think about US political risk, the potential of a President Trump coming through, what that means in terms of how you have to defensively protect your portfolio in EM credit on the risk of higher tariffs, and whether countries like Mexico actually benefit from that, and how you carve out the potential losers in that scenario.
Yeah, we've been doing a lot of thinking around what a Trump presidency possibly means for tariff wars. And I think in that scenario, there are probably winners and losers across both EM and DM, right? We expect that Trump comes in and tariffs against China. Yes, that's negative for China overall, but there is also expectation that potentially there are tariffs to Europe as well. So again, you've got to think about, say, the auto sector in Europe and what that means for that. But on the flip side of that, actually, if China is hit with higher tariffs and can't export into the U.S., then China exports into other countries. And so from an EM perspective, when you think about a Brazil or something like that, from their perspective, if China is finding other markets to send its goods to, then it's still able to sell as much iron ore to China as well. And then there's also more newer trade flows that are coming and emerging between China and other parts of the world. So we're seeing a lot more activity between China and, say, Central Asia, for example. So these are newer markets where China is able to sort of divert its products. And we also think that actually, even though there's going to be sort of tit-for-tat or likely tit-for-tat tariff wars between US, China, and potentially Europe and other parts, ultimately these prices just get passed on to consumers. So potentially we might see sort of a resurgence of some inflation at some point, but not necessarily sort of lose-lose for emerging markets.
So when this concept of I'm bringing you right back to the nearshoring conversation. When it first emerged in President Trump's first first 4 years in office, there was a really big question of how long it would take for that transition to come from Chinese export dependency to actually building out that manufacturing in Mexico. And to this day, you haven't actually seen a ton of companies make that transition. Some have, but not that many. How would that show up in terms of the bond market, in terms of Mexican debt in particular, that nearshoring conversation? How much evidence are you seeing that this is something that's more long-lasting?
Yeah, so there's been quite some conversation around why aren't we seeing the nearshoring phenomenon coming through so sort of concretely in evidence in Mexico. And we actually took a trip out to Mexico earlier in the year to sort of meet with sort of companies and figure it out. And although you do see and you do hear from almost everyone you speak to about nearshoring, actually, when you go up to northern Mexico, a lot of it is reinvestment of existing businesses in Mexico. So yes, you'll have an aviation assembly plant in Monterrey, but actually they're just building a second facility next to it. So although there's a lot of noise around nearshoring, it seems to be a lot of it is expansion of existing investments in the country. So that's why it's not coming through on that top line FDI number. You're seeing tiny ticks of it. The second part of that actually is that a lot of these sort of plants as well, they're greenfield facilities. And so it does take 2 to 3 years for greenfield facilities to actually get established fully. So whilst we've been talking about nearshoring for 1 or 2 years now, we're only just getting to the phase where financing has been sorted and now the facilities are starting to get built. So we're probably another 2 years out before we start to see real evidence of nearshoring out there. You know, there's a lot of talk about large data centers being built, large factories, all of that. It does seem like it's coming. But also, I think there's a bottleneck from a Mexican perspective that they need to find some sort of solution to the electricity problems that they have. There's a bit of a bottleneck in terms of where the electricity supply is and where the electricity demand is in Mexico. And I think that's going to be a big thing for the new Sheinbaum administration to tackle.
All right. So much. We could have this conversation all day with you. We thank you so much. Omotunde Lawal, head of EMEA Corporate Credit and Emerging Markets Corporate Debt over at Barings, joining us around the table this morning. Coming up on the program, Boeing warns on even more MAX 737 delays. We'll look at the impact onto European competition, suppliers, and customers. It's your stocks to watch next. This is Bloomberg.
Welcome back. We are 15 minutes away from the opening. Happy Friday. European futures pointing up by a very modest, just shy of 0.1%. Now, shares of the biggest US banks have been on a tear this year, with all but Morgan Stanley outpacing the S&P 500. JP Morgan, Citi and Wells Fargo kicking off earnings season today then, with investors looking past another projected drop in net interest income and instead focusing on investment banking and a rebound in loan profits. Let's bring in Bloomberg's Charlie Wells with the setup then. Let's look back to the beginning of this year. What's been the driving forces then behind those gains that we've seen for the big US banks so far year to date?
I have a hot take. Can I give it to you?
Love it, Charlie. What's your hot take?
My hot take is we've all been talking about how investment banking fees are going up, how it's deals, they're back. What we really haven't been focusing so much on, which is also a really positive story for these banks, is the regulatory environment. They are finding themselves in a much more positive regulatory environment than I think even they would have thought a year ago. They just passed their stress tests. They announced that they're going to, have higher dividends. Some are doing buybacks. But also, it is looking like those Basel III endgame capital requirements could be watered down. And let's not forget that just a few months ago, these banks were lobbying intensely for this. They were advertising during NFL games. So this is an environment that's positive for them and potentially creates space for them to do even more buybacks, which is great for their share prices.
Talk to us about the boosts, the burdens around these companies.
Look, they have set pretty high bars for themselves as far as investment banking activity, right? So Citigroup management last month was talking about how they could see a 50% growth in fees from investment banking in the quarter. JP Morgan talking about 30%. They've got to meet those, right? When you set a high bar, you've got to meet them. But I'm also interested here in the consumer, and I know a lot of analysts are a little bit concerned about it because loan growth at some of these banks has been relatively tepid, except when you look at credit card usage. And when you look at credit card usage, you see that you start wondering, is the consumer under strain? Is the consumer under strain, and are they able to pay that credit card debt back?
OK, Charlie, thank you very much. Bloomberg's Charlie Wells with the latest on what to watch. And, of course, we'll focus in on rate cut scenarios and rate expectations and see how that plays out for the banking sector. Joining us now to talk about the markets in 3 minutes, our executive editor, Mark Cudmore, with thoughts on markets. And Mark, good morning. So we've had a conversation already with Bank of America about the yen, but interested in your thoughts on what we've seen here, because it was a really big move in yesterday's session. And some would say, you know, if you're going to be the BOJ and you're going to intervene, then you do it on the back of some weaker than expected inflation data out of the United States. That all makes sense. And the B of A saying this morning, you know, it could very well have been the BOJ. What are you hearing?
Yeah, look, I think we've got no official confirmation. I need to be clear on that. But I think that is very much the consensus belief there in markets, that it was the MOF who came in yesterday. Perfect timing, of course, on that data print. Yields jump lower. What I think is really interesting is, given that it was such perfect timing, we saw dollar come lower. We saw yields come about 10 basis points lower across the board. We saw stocks come off. And yet dollar yen, yeah, sure, it had a bad day, but it still hasn't been able to break the big, you know, the steep long-term uptrend of this year. And therefore, I think actually that the price action must be very, very worrying for yen bulls. I think if it was intervention, and I must reiterate that we don't have official confirmation yet, well, then it's very likely that they would follow up again in Friday afternoon, Friday evening Tokyo time, when we get the US PPI print, even better liquidity, to really hammer home their advantage. It's the way they tend to work. So I wouldn't be surprised if we see more dramatic moves today and finally a break of that trend line, and dollar yen ultimately go much lower over the next couple of months, especially if the inflation data today gives Powell the chance on Monday to confirm a rate cut is likely coming in September, and July might even be in play. Unlikely, but in play. So dollar yen could come much lower over the next month. Ultimately, though, it still looks really negative for yen for the long term. You maybe stand aside for now, but later on in this month, macro traders are going to be excited to short yen again on crosses.
So some of the yen moves coming, of course, off the back of that CPI report. But another major move that we saw in the currency market, Mark, was cable hitting 129. And if we continue to see that weakness story, how high or how strong does cable get?
I'm getting actually pretty excited about the sterling story. I think I've been looking at more against the euro, actually, interesting enough, because I think they have, you know, divergent growth stories. You know, we were very negative on the UK economy. It's doing better. We're still pretty negative on the European economy. It's not getting particularly better. And some of the strong performers like France and stuff are getting a little bit worse. We've got the political divide. Suddenly, UK has stable political leadership. I know that sounds like a bizarre comment to say at any point in the last 8 years, but it looks like we're getting stable and strong leadership in the UK. In contrast to when we're getting very hyped political difficulties in France, one of the key pillars of the European economy. So I think that divergence is quite important. We're also seeing the fiscal situation where, you know, the concern about UK fiscal situation was done a couple of years ago and they've got their lesson. Now we're getting very worried about the French situation. So I think growth, fiscal situation, politics means that sterling can continue to outperform euro. And I do think we're potentially in a dollar turning point. I think the US election will be negative for the dollar this year. And I think when you combine that with the fact that now the Fed looks like they might be able to start their cutting cycle, they're going to start being dovish, I think that you'll see a world where dollar softens and sterling does better against the dollar than the euro does. So yes, I think cable's going to pop above 130 in the weeks ahead and can really run.
Mark, thank you very much. Bloomberg Markets Live Executive Editor Mark Cudmore with thoughts on the markets. You can keep across all the thoughts from the Markets Live team. MLIV Go is the function to use on your Bloomberg terminal. Let's get your stocks to watch. Joe Easton has a briefing for us. Joe, take us through some of the stocks that could be on the move this morning.
Morning, Anna. So we're looking at some of the aerospace stocks today. This is after more negative news from Boeing overnight. The Bloomberg Deals team and the airlines team reporting that there potentially are going to be more delays in the Boeing's deliveries. So they're saying that some of the 737 MAX deliveries are going to be delayed, potentially a 6-month waiting time on some of those planes, according to the report. This comes ahead of the next release in terms of earnings from Boeing coming at the end of this month. Now, there's lots of stocks in Europe that we do want to keep an eye on in terms of how they could be affected by delays at Boeing. Firstly, Airbus is going to be the potential winner, given they are the big rival in terms of the planes. Ryanair, however, has a massive order out with Boeing at the moment, so this is a company that could potentially get a negative impact from that. And also the suppliers to Boeing as well. There are a couple in Europe, including Safran over in France, which has had a bit of a rebound recently, as we can see. And also Senior in London tends to drop when Boeing does poorly. So keep an eye on all of these shares, given those potential delays to Boeing deliveries. That's definitely one to watch today. Then in terms of telecoms, we've got earnings out from Ericsson today. Now this one looking a little bit mixed. The adjusted EBITDA rising 14%, but the company warning that market conditions are expecting to remain challenging this year. This is amid a downturn in spending on 5G infrastructure. We do know that Ericsson is already cutting thousands of jobs. They announced 8,500 jobs would be cut at the end of last year to address the rising costs, and in March said that they would cut even more. So a lot of negativity priced in, and we can see that on the stock. Here's Ericsson on the orange line, a big decline for that one over the past few years. And we've also seen a similar move in Nokia as well. So we'd keep an eye on both of those, potentially a read across from the two, a mixed report, but potentially priced in terms of negativity. Then over in your analyst ratings, we've got Diageo today getting a sell rating at Goldman Sachs. Now, the analysts over at Goldman saying that current performance has mostly been reliant on Don Julio, the big tequila brand, but the rest of the portfolio, which includes Guinness and Baileys and lots of other drinks that you can think of, they are a drag on growth, according to Goldman Sachs. So they reckon you should be selling. It's another stock that's seen a decline over the past year, given too much inventory in people's cupboards and also in the pubs as well. And if we look on the analyst rating screens, 6 sells at the moment. And some of the big names, not only Goldman, Morgan Stanley, Deutsche Bank, all of the big banks really are saying sell this stock. Keep an eye on Diageo. That could be a weak one today.
OK, if any of that inventory is in England or Spain, we might see it depleted by Monday. We'll see. Joe, thank you very much. Joe Easton will be back with a look at those movers on the other side of the open, give us a sense of where they are trading. He'll also be back to talk about football later on in the next hour, in fact. European equity market futures then suggesting a modest bounce at the start of trade. US futures are pretty flat, actually, this hour. We saw selling of tech stocks, the dominant theme over in the United States yesterday, with the Nasdaq down by just shy of 2%. We'll keep an eye on how that trades through into Europe, if at all. This is Bloomberg. A few minutes to go until the opening trade here in Europe for this Friday morning. Let's have a quick reminder of where we were yesterday. This is the European session yesterday, gradually moving higher with some volatility in the session as well. But when we get to the US session, some negativity coming through. And Kriti, that was very much to do with technology. We got the data out, and you'll see the movement we saw in European equity markets around the time the data dropped. But we got some data out around inflation, and that had a really interesting impact on stocks. Sometimes when we get weaker than expected inflation, that sends stocks higher because of an expectation of rate cuts. That wasn't the case yesterday. Where does all of that leave us in terms of the futures picture?
It's a kind of wonky futures picture, Anna, because you're seeing green on the screen, which again necessarily doesn't make sense given what you just laid out with what we saw in yesterday's session. Nevertheless, Eurostoxx 50 futures higher by 0.1%, but the real outperformer is right here in the FTSE 100, higher by about 0.5%, Tom. And of course, even the French index higher by 0.3%. But we were trying to figure out in the break what is actually driving it, given the fact you still have some currency strength as well to account for. So we're going to see how much of that sustains at the opening trade.
Yeah, certainly in the US, it's a rotation nation, wasn't it, from the big cap to the Russell 2000. We'll see if that is a story, a theme that ripples across to Europe as well. A couple of individual names that we are going to be focusing on. Ericsson coming in with earnings slightly better than expected. It's a really tough environment, of course, for the telecoms equipment maker. They've been cutting costs. They have the deal with AT&T, and that seems, at least for now, to be paying off. Diageo being downgraded by Goldman, so we watch that stock as well. The UK-listed drinks maker, of course. And Lufthansa adjusting around the pressures in the airline space as well, particularly on less business travel, and they're looking at adjusting costs on the back of that. Anna.
Tom, those are some individual names that we will focus on. But at the overall level, then, Kriti telling us about the futures picture looking perhaps surprisingly positive. FTSE futures certainly looking quite bright this morning, and not a clear driver behind that. Yes, the oil price is higher, but we'll see if that actually materialises. So the opening trades then here for Europe are positive, not by much, but we're up by 0.2% or so on the FTSE 100. The DAX is also open. Stock 600 then flat to positive this morning. The story around yesterday over in the United States was that rotation, as Tom, you were saying, out of those big tech names into some smaller caps, into the Russell and those small caps within that. So we'll see where that leaves Europe. FTSE 100 is stronger this morning, quite substantially so, up by 0.6%. The CAC 40 up by 0.5%. Perhaps there's some energy names in the FTSE 100 that are lifting things on the back of that oil price, but it wasn't such a big move in oil. So we'll see where the drivers are coming from, Kriti, then, in terms of a deeper dive into these morning moves.
Well, Anna, your prediction was right on when you look at what you're going to see moving in the Stoxx 600 in particular. You are seeing some underperformance from some of those tech names. For example, your biggest index weight is going to be ASML, down by 0.8%, contributing by your biggest weight to the entire index. But your outperformers are exactly what Anna was just talking about. This oil story, your Totals, Shell, as well, BP, all higher on the Stoxx 600. And by the way, Shell and BP driving some of the gains in terms of index contribution on the FTSE 100 as well, Tom.
Yeah, really interesting to see the moves in the oil space, as you say. Ericsson, as we flagged, getting that lift up 5.9% or thereabouts on the back of that earnings beat coming through. We've been talking about the fact they've been driving through some cost cuts in that really challenging environment, but getting rewarded in the session today, so far at least, on the back of those slightly better results. On the downside, some of the names that are losing so far, just of course in the first 60 seconds or so, in terms of your individual names, you've got Brunello Cucinelli down about 1.7%. Direct Line, the insurance company, down 1.7%. Aberdeen also taking a bit of a hit. So the financial sector under a bit of a squeeze so far. But again, in terms of the gainers, you do have Ericsson near the top. Frontline also up there as well. And in terms of the sector basis, just very briefly, touching on the European sectors, energy is at the top of the list, up 0.8%. Tech, as we've been talking about, down 0.3%, given a handoff from the US.
Did we mention Diageo? That does seem to be a bit of a mover this morning, negative, and Joe was right to point that out to us. A sell rating from Goldman Sachs, and as a result, we see it down. I mean, it's only down 0.3%, but it stands out today. So that's what we've got at the start of the European equity trading session. We've got European stocks going higher, up by 0.3%. The FTSE 100 up by 0.6%. Let's get a look at where we are on these markets and get a view on equities. Beata Manti joins us, European Equity Strategy Head at Citi. Beata, good to have you with us on the programme. Let's get your take on what did you make of, and I know it's a different geography, it's the United States, but I think it's important to think about our reaction function when it comes to data right now. We got a weaker than expected inflation print, or a lower than expected inflation reading yesterday, and that led to selling in stocks. Some days, and particularly around big tech, some days when we've seen weakness of that sort, it would lead to buying of big tech names because the market would assume lower interest rates. So what do you think was at play yesterday?
Absolutely. Different jurisdiction. Nonetheless, the data point is important for the equities worldwide, right? Because not so long ago, we were worried that other central banks around the world, because of the Fed being on pause for longer than perhaps some would like and some expected, would mean that other central banks wouldn't be able to go on with the cuts. So definitely a positive data point going forward. It brings alive the September cut. This is our forecast from Citi US economists, that the Fed will start easing in September. And in terms of the reaction yesterday from the US markets, it's what struck me really, that all the underperformers of previous months have been doing best, and some of these rate cut beneficiaries have squeezed higher as well. So, very unexpected, lower than expected data point, and you had a knee-jerk reaction across the US market. Let's see what Europe does today, but going forward, if that's the data point that confirms actually we get the Fed to cut, and perhaps that means that the economy will remain resilient. They won't be so much pressures we could have if they stayed on pause later on. That's a positive view for equities globally, right?
Yes. So let me ask you about that. So if the Fed cuts sooner than previously anticipated, Beata, in the US, that could be good for the broadening of sentiment perhaps around stocks. And is it good for broadening of sentiment around stocks into European stocks? Is that the strategy from here?
That's a good question. This was my view back a month ago before these political tensions out of France have appeared. And yes, they are abating, but we do worry that geopolitical risks are going to continue going into the US election as well. And I'm not convinced that if Trump comes in and hikes tariffs on European goods, whether that's going to be very beneficiary for Europe. So what we've done, we've been overweight Europe for quite some time, and the immediate aftermath after the French election announcement, we've downgraded Europe to neutral and we've upgraded the US to overweight.
How much of the currency picture matters, though, for either side of the Atlantic? We're talking about this long dollar positioning. We're talking about even strength, arguably, in the euro and in cable as well. Does that disincentivize some of the moves onto either side?
I think so. So dollar strength is definitely a risk, not necessarily for global equities, where the US equities make 70% of them, right? But it is a risk for international equities. From the point of view of the US investors, really, if you worry the dollar will strengthen, it will strengthen for particular reasons. Do you want to deploy your dollars elsewhere when you worry you're going to lose on the currency there?
When you're talking about that kind of fund flow story as well, though, what might make people shy away from the United States, specifically given the valuation conversation? Do valuations even matter right now, Beata?
Look, valuations are never a reason to buy or sell at a particular point, right? They need a trigger. They need a catalyst. Are the cuts? First of all, we want to see that this inflation. It's just one data point that we've seen yesterday. Is it enough to get the confirmation of the Fed pivot? Remains to be seen. It's definitely a good start, right? And if that's confirmed and if that brings hopes of the soft landing back, then perhaps cheaper parts of the equity markets will get another chance.
But Beata, isn't Europe looking cheap? I mean, that's the argument. So you're neutral on European stocks, because we get many guests coming in here, and I know this is divided, this is a split debate, but there's the view that you have an ECB that's cutting interest rates, that growth is actually starting to pick up in Europe, and that valuations are looking cheap. But you say the politics overwhelms all of that.
In a way, this is one part of the story. In terms of valuations, I have slightly different view. I wouldn't say Europe is cheap. Europe was cheap 2-3 quarters ago. And the way we look at valuations is through our model for what is priced in for EPS by the market. And for Europe, back 2-3 quarters ago, my model was telling me that Europe was the only market out there globally that was pricing in an EPS contraction. Right now, after the rally we've been seeing, European market is pricing in, well, in line or slightly above the analyst expectations EPS over the next 12 months. So I would say it's fairly priced. Now, versus the US, of course, US pricing is much higher than the analyst expectations, right? So the bar going into this reporting season for companies to beat the expectations is much higher than in Europe. So on a relative basis, definitely Europe versus the US is cheap, but it's not as cheap as it was on its own versus the start of the year or end of this year. So focusing on fundamentals going forward, have there been any cracks in the fundamentals? So we've been highlighting and worried about that. The moment the snap election has been called in France, earnings revisions, so the direction of the analysts' forecasts for Europe, but especially for France, have been going down very, very strongly. So it's not only a coincidence that we are going into the pre-reporting season and analysts tend to downgrade their forecasts, right? You catch 3 months of upgrades, strongest upgrades around the world were coming out of Europe that was underpinning the rally. And now we've had a few data points that suggest some pressures or rolling over. Perhaps it's just a blip, but I'm watching that very carefully.
What you talk about the fundamentals and you have that preference for the US. To what extent is artificial intelligence part of that fundamental story? I was at a tech event yesterday and the debate was still live as to whether or not this is overshot and overrun to some extent. Where are the stocks that have not really benefited, that have that exposure but haven't seen the flows, and that maybe there's a window there to add?
Absolutely. So in terms of AI, of course, the biggest impact on fundamentals come from the US. So just to put it into context, the US market is expected, so the analyst expectations for this year are for plus 12% EPS growth. Now, if we exclude from S&P 500 Magnificent 7, this plus 12% becomes plus 6%. So significant. It's not nowhere as big, of course, in Europe. In Europe, the EPS is broader.
Can I ask you about your expectations around the UK then? We obviously have more political certainty than we've had for quite a while in the UK now, given the size of the mandate for the Labour Party. I know that you prefer the FTSE 250, which is, going to be more domestically exposed. I was interested, though, in some news we had this morning from the Investment Association saying in the month of May we saw a continuation of what's been an 8-year trend of retail investors pulling money out of UK stocks. Now, the retail sector is not the only thing that matters, and, of course, your calls are about something wider than that. But how do you look at the UK at this point?
Absolutely. So in terms of these retail flows, but also institutional flows, we've been seeing these structural outflows, not only out of the UK, but Europe only equity funds. And what has been happening is that these funds have been transforming into global funds. So we've been seeing inflows into global funds, decent inflows. And of course, Europe and the UK are beneficiary of these inflows there as well. So that's just a caveat to these outflows from the UK or European funds only. Now, in terms of the UK, we think the election is definitely a positive data point to regain investors' confidence. Rate cuts are coming. The economy is picking up. We've seen that in yesterday's data, right? And what is very important as well is the direction of the pound. I know you've been talking about that earlier. So stronger pound should be favoring this small and mid-size space within the market, and it is more growthy, it's more exposed to the rate cuts than FTSE 100, which is really a pure value, so it doesn't have this sensitivity to the cuts, and it has bigger sensitivity to the weakness in the pound. Perhaps going forward you could expect some strength, right?
Okay, so you lean into the FTSE 250, maybe arguably over the FTSE 100 here in the UK, with that focus on small or mid caps. Are you seeing flows out of France? Would you expect to see flows out of the French market? And what would you need to see to kind of dip your toe back into French equities?
So our models, regression models, suggest that the outcome, the political outcome we got out of the elections has been broadly priced in already by the end of the previous week before the election. But as I've said before, the biggest downgrades, and it's not only the direction of the analysts' forecast, but also the actual EPS for this year is coming down substantially for France, much more than in any other part of Europe. So that worries me, really. So the market is still not particularly cheap. Of course, it got cheaper. And I really would like to see some positive news on EPS and inflection points that these downgrades have, that are signs of these downgrades abating.
OK, thank you so much. Thanks for joining us, Beata Mann, the European Equity Strategy Head at Citi. Let us get to the core six, shall we, Kriti? Let's have a look at what we've got happening there in terms of market moves this morning. LVMH up by 1.3%. So to some degree, that continuation of the rebound in French stocks, given the heavy selling we saw around the calling of the election, seems to be one of the themes we're dealing with.
Yeah, one of the outperformers. We should mention ASML moving by almost the same margin to the downside as well, down about 1.2%. Novo Nordisk and Ferrari also higher by about 0.5%. So you are seeing some pretty decent moves in the mega caps as well. That is your large cap story. Let's get a check on some of the individual stocks on the move with Joe Easton. Joe.
So we're seeing Ericsson actually gaining around the most in 4 months at the moment, up almost 8% following earnings from the telecoms infrastructure firm, actually rising to the highest level since 2022 now, so recovering all of the declines that we saw last year. The orders actually coming back in the US, according to a note from Jefferies today. The Indian market, though, still looks weak, and that is a big business for them. But for now, the US orders, that AT&T order as well that Tom mentioned earlier, actually boosting those sales at the moment. A little bit of a read across coming through in Nokia as well. That one up around 2% over in Helsinki today. There's some other earnings to bring you. Another luxury one that is gaining at the moment. It was gaining when I was at my desk, but it's actually come down. Brunello Cucinelli over in Italy, the maker of fancy cashmere sweaters. They've got some numbers out today. They're heavily exposed to high net worth individuals, according to Citi, but that is not helping too much today because the stock coming down after those earnings. Got a couple of asset managers on the screen, but very different stories. Partners Group in Switzerland, seeing some really good AUM at the moment, but assets under management in Ashmore, which is a London-listed emerging market asset management, actually seeing a lot of money flowing out of that, a negative sign for emerging markets, and that one's down 3% today. And over in oil, we've got Aker BP in Norway. They've got some earnings as well, but this is talking about projects, new projects in the seas out in Scandinavia, actually doing pretty well for them at the moment. So we're up 1% on that one. We'll check in on some of the airline stocks because this is a bit of a theme today and has been a theme this week. Airbus pretty much unchanged, not too much of a boost from news that Boeing actually seeing some potential further delays to 737 deliveries. Ryanair weakening though. Remember, Ryanair has a $40 billion order with Boeing outstanding at the moment, so potentially that is weighing on that. Then we've got Safran. This is a supplier to Boeing as well, we mentioned earlier, and Senior PLC. Keep an eye on those. Not too much movement, but worth watching airlines as well. We have also got another airline stock to bring you. This is Air France. It gets a downgrade today over at HSBC. HSBC cutting a number of airlines this morning. I think they've got a rating out on Ryanair as well, but they have got ratings on a number of stocks. We saw Delta Airlines in the US yesterday cutting its guidance. The sector fell, so it is a theme for the week. And then finally, Goldman cutting Diageo. Now, there's already 6 sells on that, but Goldman joins the sell pack on that one. Very slightly lower. The price target suggests some downside. The maker of Guinness, my favourite beer, is declining today.
Thank you very much, Joe. Joe Easton from our equities team with his beer recommendations and stocks on the move this morning. More from Joe later this hour. Coming up on the programme, though, we'll return to the serious business of global geopolitics and global security. Reports emerged that US and German security services foiled a Russian plot to kill the boss of one of Europe's largest arms manufacturers. We'll bring you the details shortly. This is Bloomberg.
Welcome back to the opening trade. Happy Friday. 21 minutes into today's session then, and you are seeing some very modest gains across European stocks, up 0.2%. As you can see, on an individual index level, some strength coming through for the FTSE 100, adding 33 points so far in the session, up 0.4% at 8,257. Also decent gains over in France. The CAC 40 actually up 0.5%, up 38 points. Really pronounced rotation yesterday in the US session from big tech and the semiconductors to the Russell 2000. We'll watch to see if that theme continues in the US session. S&P E-minis are currently flat. Nasdaq futures down 0.2%. Let's get to a really fascinating, intriguing and frankly quite concerning story right now, because Bloomberg has learned that US and German security services foiled a Russian plot to assassinate the chief executive of Rheinmetall. It's a German arms manufacturer producing weapons for Ukraine, but for the rest of the continent as well. Let's, at this point, then, bring in Bloomberg's Brussels bureau chief, Kevin Whitelaw, for the details on this. Kevin, what do we know about this assassination plot, how it was foiled, and what it tells us about Russia's intent?
Well, this is something that apparently the U.S. intelligence services discovered and then tipped off the German authorities so that the Germans were able to go and actually sort of stop it. We don't really know all the details, but they describe it as a reasonably mature plot. So it does seem like there was something at least somewhat, significant going on here. It's obviously an enormous escalation and quite a provocation from Moscow if this is indeed something that originated there, which is what so far the authorities seem to believe. So, he was put under protection, and they think they've at least stopped it for now. But if these details are confirmed, it really shows just a whole new level of sort of aggressive direct tactics against, in this case, a very key producer of weapons for Ukraine.
Kevin, this broke at the same time that you had world leaders gathering in Washington for the NATO summit as well. What was the reaction on the ground from this kind of multi-pronged approach from Russia?
Yeah, well, obviously, there's been concern about this. They've been talking about this for a while in a number of different NATO countries, particularly those that border Russia, the Baltic states, Finland, and others have already been warning about these kinds of hybrid attacks, whether it's what they call instrumentalized migration or other things for quite a while. So Russia has been doing a number of things slightly below the radar aimed at disrupting and various countries. What I think this episode really shows is the reminder of the role that the U.S. and Europe play when they cooperate and work closely together. As I think a lot of NATO allies are really looking over the horizon to the possibility of Donald Trump winning re-election, there's a huge amount of concern about what that would do, both for the U.S. support for Ukraine, but also more broadly, the U.S. role for helping as a partner with Europe to defend its security.
Yes, and with that in mind, Kevin, we saw a number of European leaders, or at least their teams, trying to get in touch with President Trump's teams over in the United States during the NATO meetings to try and get a fuller understanding of U.S. policy options into next year, maybe under Biden, maybe under some other Democratic leader, or maybe under Trump. And Biden's performance then moved front and center, didn't it, for all of Europe?
Yeah, I mean, look, everyone was watching the press conference and trying to figure out how he was going to do. And obviously, this one went better than the debate, but there were those high-profile gaffes that he made. He confused his vice president's name. He misspoke when he introduced Zelensky. Those were pretty painful things to watch, given the context of the debate. If we hadn't had that debate, the press conference probably would have been a somewhat unremarkable moment, but we did. Everyone's looking for those moments, and Biden is simply unable to do something, to do enough, I think, in the days and weeks ahead to sort of erase the debate and really reassure people that he's sort of ready for another 4 years. It's an enormous task to rewrite that narrative, and it's just not clear what he'd be able to do at this point to sort of wipe that slate clean.
Yeah. Kevin, as we look back to the hybrid warfare question, Russia and its involvement, and you oversee, of course, this region that has seen a number of these hybrid attacks, it seems. What is your understanding of NATO's potential response? At what point they have to draw a line in the sand around some of these actions?
Yeah, I mean, I think that obviously NATO does have the sort of self-defense mechanism in the pact that can get activated, but it is something that sort of the allies have to agree on, and so at some point that becomes a decision that they'll have to take together. I think it would have to be something very overt, very significant for it to be a true NATO response. You are seeing NATO has stepped up very carefully in terms of its level of involvement with coordinating support to Ukraine, because it has not wanted to provoke a direct response, a direct conflict with Moscow. It's been a very carefully orchestrated thing. The EU took the actual lead in some of the logistics for a long time. Member states were doing things on their own. They're really, really desperate to avoid.
Kevin, we've got to leave it there. I'm so sorry. But Kevin Whitelaw, Brussels Bureau Chief, we thank you so much. This is Bloomberg. This is the opening trade. We're about 30 minutes into today's session, seeing green on the screen, higher by about 0.5% in the French index, actually, so seeing some outperformance there. But green on the screen for the rest of the markets as well, and that's going to be really interesting when we talk about whether or not this can actually sustain going into the next couple of weeks, especially, of course, as Europe and the United States perhaps takes a little bit of holiday over the summer months. For now, though, a little bit of positivity, not only in the stock markets, but in the FX markets as well, which brings us to what that actually looks like in terms of the ripple effects going into the dollar, euro, the cable, the strength we're seeing in the currency market broadly. We asked Ralph Presser that very question earlier in the show. Take a listen to what he had to say.
The dollar is overvalued on any measure, right? If you look at the real effective exchange rate, it is at an all-time high. It does make sense for the dollar to start giving some of that up. What has been preventing that from happening until now is the fact that we had this uncertainty about when the Fed would actually start going. Remember, until quite recently, we were debating whether or not other central banks would be able to cut if the Fed doesn't. And that uncertainty now is meaningfully reduced. That will certainly help the dollar give up some of that richness.
Joining us now, Supriya Menon, head of multi-asset strategy EMEA over at Wellington Management. Supriya, pleasure to have you on the program. Thank you so much for joining us this morning. The argument that Ralph was making is that the positioning going into the election right now isn't actually all that clear. Meanwhile, you are seeing potential strength in the European currencies that are looking to continue. How does that have a ripple effect in some of the other cross-asset story?
Yeah, absolutely. And just starting with those currencies and underlying that are the rate parts. Major central banks have been fairly desynchronized. So we had the ECB moving ahead of the Fed. And what we see now with the inflation print yesterday, giving more confidence to the Fed to act, is that we potentially will see some resynchronization of those rate parts. And so while the dollar has been strong, you could see it giving up some of those gains. And we've seen the sterling strengthen, of course, and that also reflects the relative strength of the UK economy.
Well, that strength, though, how long does it last? Because, yes, it feels like it's a function of the UK economy strength, but it also feels like it's a function of that political stability narrative that we are arguably just now seeing in the UK. But is that a knee-jerk reaction, or is that just kind of one that is actually going to sustain despite some of the issues and the structural weakness you still have in the UK?
Yeah, absolutely. And you pointed to a key weakness of the UK, which is that investment has been languishing, and that's gone hand in hand with so that's driven by weaker confidence, but gone hand in hand with, sort of lower valuations for UK assets and so forth. Now, the strength of the cyclical strength of the UK economy came through in the recent GDP print, and that, of course, preceded the shift in the change in government. And we saw growth come in well above expectations and well above the Bank of England's own expectations. So that cyclical momentum might well stay in place, and that actually challenges the rate cutting part for the Bank of England. So that cyclical strength is definitely coming through in the UK, and arguably stronger than what we see in the Eurozone and definitely in the US in terms of cyclical momentum.
OK, cyclical strength in the UK. When it comes to the US, and the rotation that we saw yesterday was pretty pronounced in terms of from big cap tech to the Russell 2000 and those small and mid cap stocks. Does that continue? Was that a pivotal moment? Is rotation the theme now going forward for the US?
Tom, speaking of earnings, actually, we really firmly focused on earnings, and that sort of has driven the relative strength of the mega cap tech stocks, because there's been a big gap between the earnings that have come through from those larger stocks and the rest of the market. Now, when we look ahead, we see big cap tech moderating in terms of the earnings that they can deliver in the coming quarters, and expectations are for the rest of the market to close the gap with mega cap tech. And that means that earnings are broadening out, or expected to broaden out, and that would certainly be our expectation as well, which drives the view that you should see a broadening out of price gains as well across the market. And that would be a healthy development, given the fact that, looking backwards, we've had this very, very concentrated advance.
So would you fund a move into some of those broader name stocks, whether that's a Russell, by selling down some tech at this point? Is that how you fund that trade?
At the moment, we would expect a broadening out. So we're positive on we expect some of the laggards to catch up. So be that small cap stocks, be that more cyclical areas of the economy. That's more the case in Europe, where we see stronger cyclical momentum. In the US, there's more of a mixed case for that. But generally, we see a broadening out beyond tech. So so we'd expect some of the mid-cap stocks and small-cap stocks and some of those laggard sectors to catch up.
Supriya, can I ask about this cyclical momentum in Europe and where that leaves expectations around rate cuts in the UK and with the ECB, I suppose, as well, even though the ECB has started cutting, of course, the Bank of England hasn't. What is the link there? Because we were talking in the last hour of the programme with Ralph Prosser from Bank of America, and he was sort of separating out the Fed's decision around the underlying strength of the US economy and rate cuts. He was saying it's not going to be a reflection of real weakness in the US economy. It's a different story. And I wonder how much that applies here. Even if we see a cyclical uptick, for example, in the UK, do we still get rate cuts?
Overall, we expect rate cuts to come through. So that's in the US and in the UK. Now, how does that affect, how does a recent cyclical upturn in the UK affect the Bank of England's rate path? We believe they're biased to cut, so they will cut, whether that's in August or soon afterwards. However, what that might mean is that you have, it is quite challenging in terms of managing sticky services inflation. So what you might get is quite a shallow rate path. And indeed, that's implied in rate expectations across the board, whether that's in the US, whether that's in Europe. So what you might get is a more shallow rate path, and that's exactly what we'd expect.
So that's the impact that cyclical upturn has, is they cut, but they don't cut by very much. We've clearly been focused on the politics here in the UK. We pass that baton across the Channel and across the Atlantic, perhaps later in this year. How are clients you talk to, investors generally, thinking about the US election? Again, we spoke to Ralph earlier, and he was saying the message he's getting from investors is it's too soon to trade the US election. You know, we've got a lot of rate dynamics, a lot of data to deal with before we get there.
Absolutely, and we are in an environment this year where 70% of the world's population have been involved in elections, and while we're firmly focused on valuation, earnings fundamentals, and so on, which are generally strong, that's why we're pro-risk. There is a little bit of a tug of war between political dynamics, geopolitical dynamics, and market strength and strong fundamentals. Now, in terms of the UK election, the US election, specifically, what we'd expect is, if you see a rising probability of a Republican trifecta, so not just Trump, but a united Congress, you should see the market moving towards probably, sort of a more inflationary setup. And that means an expectation of higher inflation and higher rates down the road. So that's what we'd expect to come through there.
I want to circle back to the cyclical story that you're talking about specifically in Europe. It feels like it's a very contrarian take from what we've heard on the show, because cyclical, and correct me if I'm wrong, implies that there's capex spending, that there's manufacturing strength. Aren't we seeing the exact opposite when it comes to the continent? So explain to us why, or where you're seeing evidence that this move in Europe is cyclical as opposed to defensive, not only in terms of kind of that technology read-through from the States, but actually defensive in terms of defensive stocks, bonds, et cetera.
Yeah, absolutely. In Europe, so it's focusing on the Eurozone specifically, the strength has actually been driven by the services side of the economy. So when we look at, and that's reflected in the regional makeup of that cyclical momentum. So the periphery has been stronger. They're more driven by services. Now, one of the things that we've been focused on is the outlook for the consumer in Europe. And the consumer has been actually, is in a good place. A strong balance sheet. They haven't spent down the COVID stockpile of savings to the same extent as we've seen in the US. And generally, the labour market has been robust, and real wage growth is coming through. So the consumer should continue to drive strength in the euro area economy. Of course, there has been some disruption from some of the political dynamics we talked about earlier, but that drives a more positive view of the euro area economy. That being said, we are watching for any signs that some of the political disruption could also stymie some of the cyclical inflection that I mentioned.
You look at credit as well. You're overweight credit. What underpins that view, and has the window closed to kind of getting exposure to credit as we look at those potential rate cuts? Where within credit are you looking at opportunities?
Yeah, absolutely. So our positive view on credit is driven by the carry. So we expect spreads to remain tight. They are tight, but we'd expect to remain there. And so that carry really drives our outlook. And this is also driven by the fact that we believe that, sort of the default cycle has topped out, and also by some positive technicals for the credit markets. For example, the size of the market has shrunk.
Do you have to carve out France and French credit from that broad overweight on European credit? Do you have to sideline France?
No, actually, there are opportunities, for example, in French banks. And we'd expect that European credit should be well supported. And there is, in fact, some more spread compression to come through in European credit specifically. Not necessarily the case in the US, but that drives our overweight view on European credit.
As luxury French stocks doing pretty well today, which is interesting. The CAC 40 outperforming a little bit, up 0.5% on that luxury theme. Big luxury buyers, of course, in China in better times, maybe not quite up to it on the Chinese consumption front at the moment. We're going to focus quite a lot on China next week. We're going to get lots of data out, GDP, for example. You're pretty neutral on on China at this point? What do you need to see to change that view?
Yeah, so in China, the main headwind has been structural. So on the one hand, you've had policy fail to put a floor under the property market, and that's meant that those structural headwinds have not been, in a way, managed through policy action. And that's meant that the private sector has been really, really weak. And confidence has been low, and we don't see that coming back. So we need to see, the cycle improve from here in order to turn more positive, but also the structural headwinds make that a little bit more difficult. And we are in the third plenum period, and the messaging that we're getting is that the focus is firmly on stability and the long-term policy goals rather than immediate policy action.
Yeah, that important meeting, as you both suggest, happening, of course, in China next week. So we'll see if anything consequential comes out on the policy front. Supriya, thank you very much indeed. Supriya Menon, Head of Multi-Asset Strategy, EMEA at Wellington Management. Coming up, it is, of course, a huge weekend for sports fans. We've got England taking on Spain in the Euro finals. We're going to talk the business of sport and preview one man's intrepid trip to Berlin, Joe Easton, for the match. That's next. This is Bloomberg.
Welcome back to the opening trade, Friday morning, 8:45 here in London. And we see stocks in Germany pretty flat this morning. The CAC 40 outperforms, up by 0.5% this morning. Luxury names over in Paris doing pretty well. Let's turn our attention to European politics. Manfred Weber, the president of the European People's Party, says he's confident that Ursula von der Leyen will be confirmed for the second term at the head of the European Commission. She faces a vote in the European Parliament next Thursday. Back in 2019, she scraped through by just 9 votes. Weber spoke exclusively with Bloomberg's Max Ramsey at the European Parliament in Brussels.
I'm very confident for next week. So we are collecting now support among the other political families. As EPP, we are the winner of these elections. We gained seats. We won again these elections. And we nominated beforehand, before the elections, Ursula von der Leyen as our Commission President candidate. So it's also a very democratic approach how we do things. We show in transparency what is our content and what is also our lead candidate for the future. And now it's up to deliver. And we want to have a democratic Europe. That's why the European Parliament should really support the lead candidate from the biggest political family, that's the EPP.
And, I mean, when we talk about having support and delivering, I mean, do you think that you have support, for example, from the Greens? Have they indicated to you that they are willing to support Ursula von der Leyen?
We have also on council side a clear commitment between the 3 main political groups in Europe. That's the Christian Democrats, my party, the EPP. We have the Social Democrats, and we have the Liberals on European level. Probably also linked to the big leaders. We have Olaf Scholz, we have Emmanuel Macron, we have Donald Tusk. They are representing all the political families of Europe, and they agreed together with the parties that we have a common package to create stability for Europe. After the elections, Europe must be grounded on the stability in the center. That is what Europe needs in this moment of time. I am happy that we reached this agreement with Costa on the council side, with Kaja Kallas on the High Representative, and with Ursula von der Leyen as next Commission President. And next week we have to deliver as parliamentarians on this kind of key promise. We have so much uncertainty, so much instability all over the world. Look to America, what is there, what are there the discussions. That's why I think it is our task now to create stability in Europe.
Manfred Weber, their president of the European People's Party, speaking to Bloomberg. A couple of other things to watch on the docket for today, and of course going into the weekend, is 1:30 p.m. UK time is that U.S. PPI data. Remember, it comes right off the heels of that negative print in headline inflation in the States. Will we see a similar reaction in the bond market, the 12 basis point move we saw yesterday in the front end of the curve as well? 3 p.m. UK time, all about that UMich consumer sentiment data as well. Just one more data point to add, and of course, I think starting early in the U.S. morning, I want to say around 8 a.m., you're going to start getting some of those Wall Street bank earnings. Citi, J.P. Morgan, Wells Fargo, BNY Mellon, all hitting the tape, Tom, when it comes to kicking off earnings season on both sides of the Atlantic.
Yeah, it's going to be interesting, isn't it? And Charlie Wells set us up really nicely in terms of what to watch for when it comes to the bank stocks, of course, with those numbers dropping later today. So we'll bring you all of that. We're going to switch focus right now to the event of the weekend, though. England's men's team, the women did it, they won. Now the England men's team need to catch up, step up to the bar. The football team, of course, will take on Spain in the UEFA Euro 2024 final in Berlin on Sunday. Who better then to bring in Joe Easton from Bloomberg Stocks team for this? With the focus, let's start, before we get to your epic journey, because you're going to be heading over there, Joe. We're all slightly envious of that. I certainly am. But before we get there, in terms of the stock market importance of this, you're looking at some names that could move on the back of this, a potential England triumph or potentially Spanish triumph. What happens? What stocks are you looking at?
Yeah, well, I mean, less of the Spanish triumph.
Yeah, let's keep that.
Shall we just acknowledge the fact that this is an entirely biased desk? Kriti is doing her best to support Spain.
Exactly. I'm sitting way over here on purpose.
Yeah, exactly.
So, yes, anyway, that said, we acknowledge our bias. Now moving... Yes, Joe.
So there's been some interesting research out done from some analysts. I think they have a bit of fun with it as well. So there's a note from Morgan Stanley talking about how when England do well in tournaments, you see a very clear increase in pub sales. So it's not just England being in the tournament, but when they actually progress further, the gain to pub volumes is actually bigger. And then you can also see some data in the hotels over in Germany. So in the third week of June, the average cost of a room in Germany was around 30% higher than the weekly average because there was 24 teams in the tournament at that point. So 24 different countries all trying to buy hotels in the same place, and of course the prices go up. So there is clear research done on the market impact.
So there we are, that's tick, but lots of sensible business commentary. Let's think about the politics and how this might play out. Keir Starmer, new leader in the UK, has been at the NATO summit, and a lot of people have been trying to get his thoughts on the game, because he is, of course, a big football fan. And also, there's rising expectations. Will there be some kind of celebration on Monday if there were to be victory? But he doesn't want to tempt fate.
Yes, so there were some reports in London press about a potential parade, so something to look forward to if we win. But obviously, we've still got the game to get through. But yeah, no, he is a big football fan. It's not kind of often politicians when they talk about football, it is kind of just to get in the headlines.
He plays five-a-side.
But he plays five-a-side every week, so he's been known as this.
He's a legit football fan and of the best type, because he's an Arsenal fan.
Arsenal, unfortunately.
He gave President Biden.
I saw that. Yeah, I think that was quite cool.
Nice gift. I'm sure that's on the so
Can we get to the important stuff, which is how did you get a ticket?
So I've been.
And also, are you taking me?
You're on the spot now.
Look, I'll speak to my contacts. I've a great friend of mine, Simon. I'll give him a name check because he's a long-suffering England fan, and I've been to a couple of games with him over the years. So he's managed to get me a ticket. So shout out to Simon. But yeah, I've got to go on a travel all around Europe to get there. I've got to fly to Prague and then get a train from Prague into Germany and then another train into Berlin, and it's costing me a fortune.
So there are no flights? The flights are all booked up?
Every flight in and out of Germany from London is completely booked. And I can't actually get back until Tuesday because there's no flights until Tuesday. So I've then got to get a train to Hamburg and fly from Hamburg to London. So,
wow.
So if the producers are listening, I won't be here.
You won't be here on Monday. That's what. Yes, and you're blaming the travel.
Yeah, I'm blaming the travel.
Yeah,
exactly.
Shame that, isn't it? Shame you can't get back. I was listening to lots of reports yesterday talking about the cost of it all, and I was thinking, those poor people who are having to pay so much money to go. And
It's all my life savings, but it'll be worth it.
Very small violin at this point for Joe. Given you've actually got a ticket, you're going to be in the stadium.
But what if we lose? And I've spent
aren't you also a Spanish speaker?
I am a Spanish speaker as well, so
you maybe kind of slightly win?
Mucha suerte los españoles. I do a bit of show.
We've done our bit, showing off. Support both sides.
Show off while I'm here as well.
Joe, your mate Simon, how did he give us the insight? How did he get this ticket then? Can we? Is the window still open for these things? Is this a black market job, Joe?
Well, no, I tried on the black market. No, I didn't really. But so he's built up loyalty points over the past 2 years from being a long-suffering fan. And,
58 years of pain is what
that's
BBC
it.
is.
And then you get in. Yeah, exactly. But I'm happy to be. Well, I'm buzzing, to be fair.
Do you have a prediction for us? A prediction?
My prediction, I'm going to go with 2-1 England. Yeah, 2-1 England, 2-1 England.
2-1 England.
2-1 England.
All Tom wants to know is, will there be extra time and penalties? Because that will be painful for him on Monday morning.
I think our midfield might be a bit uncertain. We've got to go up against Rodri. Yamal's looking good. We might be overrun. But if the way our attacking players played in the last game. We look like we can beat anyone. We look like we can score against anyone. We look like the best team in the tournament for half an hour.
On that first half
an hour. I was about to say.
For half an hour.
Let's not get excited. It was more towards the end, and it was no one saw it coming.
But I think if we play like we did for that half an hour, it was only half an hour. But if we play like that, then we can win.
It was like the 90th minute.
Yeah. Well, yeah. We might need a last minute goal again.
All right. Bloomberg's Joe Easton going to come back and give us the full read through, plus souvenirs, of course, for everyone.
Incredible sacrifice that you're doing this reporting for us. Thank you so
really
much.
Taking it hard. We pity the man. And to go from what's going on in the weekend, let's actually bring it back to what's coming up later today, and that is those Wall Street earnings stories. You have J.P. Morgan, Wells Fargo, Citi, BNY Mellon, all going to be talking about not only in the terms of loan losses, in terms of the cushion that they need, but I'm really curious, of course, of Jamie Dimon and BNY Mellon talking about what we're seeing in terms of these rate cut bets. And you know, Jamie Dimon has been a very big advocate of the economy. I'm curious whether this inflation print changes his view.
You managed to get market plumbing in earlier in the show, so that opens up an opportunity when you talk about BNY Mellon. Yeah, look, to what extent is investment banking coming back, the trade, the capital markets? To what extent is that going to be a propellant for these stocks that, as we've said, have done so well, outperforming the overall index year to date, most of them? Is loans going to come through as well? The consumer is part of the mix. There's a little bit of pressure there, but if rates come down, does that help the consumer?
Yes.
So positioning the gauge across the economy as well, really important.
I like the attempts of the team, and particularly around the table, to bring us back to the focus on markets. It's excellent. But there are
normally you're the anchor.
I know. Normally I'm
back.
Extremely sensible, but it's Friday, and we are looking ahead to. There's also Wimbledon, isn't there? There's lots of sport.
Let's not forget Wimbledon's fantastic.
But it's also a really busy weekend of weddings, I'm told. Now, this is not my specialist subject, but I'm told that celebrities of all types from the worlds of fashion and sport are expected to join the biggest names in global business. This is what I was getting to, at a lavish family wedding thrown by Asia's richest person. This takes place today in India. Months of celebration have led up to this. I mean, this looks like this is rivaling a Davos, isn't it? The people.
$320 million.
Do you also have an intense travel schedule this weekend?
I am not going to the Ambani wedding. No, that is not the big reveal at the end of this. I hate to disappoint.
You're one of the celebrities.
I obviously didn't try as hard as Joe Easton did to get hold of that England-Spanish ticket. But it is incredible, isn't it, that this has become... Of course, it's a wedding, but it also seems to be a gathering of some incredibly wealthy and influential people.
Well, we should just put into context, this is a cultural thing, that in Indian weddings, everyone invites not only everyone they know, they invite
but
business contacts. I mean, but they invite business contacts. Yes. I mean, this is quite normal even in not billionaire weddings, is for Indians to do that. So it's not that surprising that they're inviting people that they are looking to grow and build partnerships with around the world. So.
Yeah. And when you're an Ambani, you do it in some style. That is it for the opening trade. Back to the markets, and European stocks are up by 0.2% this morning. France outperforms. The pulse is up next. This is Bloomberg.